Hello everyone, I hope all of you are doing really good. So welcome again to another new session on the chapter called Financial Markets. So what are we going to be learning today? So we are going to go ahead with our mind map, and before we can go ahead into our mind map, it's important for you to understand about this chapter. Why? Because when it comes to weightage of marks, this chapter stands third in weightage of marks, at least 18 marks. Weightage goes for this particular chapter called Financial Markets, and it is a chapter where you need to understand with visual pictures. Only then it's gonna make learning easy. So in our last, what was the topics we learned? We learned about introduction of financial markets, meaning of financial markets, the concept and the functions of financial markets. Then the classification of financial markets, I just put a picture for you last class for us to understand that the financial market is divided into money markets, which is short term, less than a year, and capital markets, which is greater than a year. So today we're going to be concentrating on money market and its instruments, and capital market, the meaning. And capital market is divided into primary market and secondary market. So in that we'll be learning today the difference between primary market and secondary market. Okay, so the difference between primary market and secondary market is what we're going to be learning in today's session, along with money market instruments. And later, the next session, I will be teaching you the methods of flotation, because that needs, again, I cannot cover it in the same session. So now let me go ahead and start. Now again, to do a brief up of what is the meaning of financial market, it is nothing but it's a market. You know, a market is a place where you go ahead and you buy vegetables, or you want to buy a television, or it's a place where you go ahead buying and selling goods which you require, or probably even services. So what's a financial market? Here an organization needs money. The organization is raising money with the help of the public, asking them to come and purchase their shares or the debentures, or to buy the money market instruments. So this is called as financial market, where the investors or the public is coming ahead and trading with the organization, and they're investing their money and they're buying things. So how are they doing all this? They are doing it through a market, through a financial market online. They are going to do it. So the classification of financial market we already learned last session, but again I want to go ahead and describe the classification of money market. Sorry, the financial market. The financial market is divided into two: money market and capital market. Now money market is not divided into anything, but it has something called as instruments under money market. Okay, it has instruments under money market. So under money market there is nothing that is there's no types, there's no division, but there's instruments of money markets. And capital market is divided into primary and is divided into secondary. Okay, and here again in capital primary market we will be learning the difference between primary market and secondary market, and the difference between primary market and secondary market. And in secondary market we will be learning stock market and the over the counter. Now this is the classification of financial markets. How is it being divided? And the same thing is put here for you in notes so that it's easy for you to understand. So the next one is, okay, the next one is be moving to what is the meaning of money market. Now money market is nothing but you are investing. Now you are the investor and the organization. You are investing your money in buying certain bonds or buying certain paper documents which has a lot of money value, and the maturity period is less than a year for these particular money market instruments. So the maturity period is less than a year and it's highly liquid. That means anytime you want you can sell them, and it is very advantage because the maturity period is soon and the interest what you're getting is also high. Now what are the instruments of the money market? This is a definite 8 marker, or maybe asked for a 4 marker. Please ensure you're marking it down, making notes. I've included a lot of pictures so that it's easy for you to understand. Now what are the instruments or how the public can invest their money into these money market instruments, or how the organizations can get money out from the investors or the public. Now these are the 5 money market instruments which is very important and is very easy. Why easy? Because for all these the maturity period is less than a year. So you need to know for all this, like example, if you say treasury bill, you need to know the meaning of the treasury bill, you need to know who is issuing the treasury bill, you need to know the maturity period of the treasury bill. Same thing with commercial paper, you need to know who is issuing commercial paper, who is issuing means who's selling the commercial paper, then you need to know the maturity period of the commercial paper, and then you need to know then you need to know the meaning of the commercial paper. So the same thing, so these 3 questions are common for all these 5 money market instruments. So what is the questions? First you will know what is the meaning of these particular, let's say treasury bill, commercial paper, called money, you will have to know the meaning. Second thing, who is issuing them, whether it's RBI, Reserve Bank of India, whether it's an organization, whether it's a bank, who is issuing it. Third thing is what's the maturity period, that is when exactly you can sell it and when are you going to get your money. So that if you know these 3 questions, if you know the answer, you are good to do in this particular 8 marker or 4 marker. So this is your examples for what I have put. Like example, this is a treasury bill, okay, and this is a certificate of deposit, and this is a certificate of this is a certificate of deposit, this is a commercial bill, okay, and this is a commercial paper. So call money, I don't have any I'm not put up any pic here, but you will understand why I have not put up any pic here. Okay, now let's move on to the first thing. I know there's a lot of things put up here on the screen, but it's very simple for you to understand. The first question is, what is the meaning of a treasury bill? Treasury bill is a short-term debt. That means what? The company is in need of money. Because if the company is in need of money, they are asking money. Who is issuing? That means who is asking the public for money? That's the government of India. The Reserve Bank of India is the one who is asking money from the people. Okay, and what is the maturity period? Maturity period is 91 days, 182 days, or 364 days. Okay, so the first question is, it is a short-term debit. What is a treasury bill? It's a short-term debit. That means less than 1 year. Okay, short-term means less than 1 year. It's an instrument which is short-term debit, which is issued by the government of India, which has a maturity period of 91 days, 182 days, and 364 days. Now, what is this treasury bill? Along with you telling it's a short-term debit, you will tell that it is issued at a discount and it's redeemed at par. Now, what is the best example for me to give you this? See this example here. So this answer is pretty much easy. Now, example, you are buying a treasury bill for 91 days. Okay. So this treasury bill is of 100 rupees. That is the face value. That means the original value of this paper document of the treasury bill is 100 rupees. But the company or the government is selling at 98 rupees. That is the discount. Example, you buy clothes on discount, right? The MRP price on the t-shirt is, let's say, 500 rupees, but you're buying it at a discounted price of 300 rupees. So what are you? You're saving 200. Okay. So the same thing is with the treasury bill. The company, the face value of the treasury bill is 100. Okay, so the face value of the treasury bill is 100. But what are you doing? You're buying it at a discount. Why? Because the company or the government is issuing it to you at a discount of 98 rupees. So how much are you saving? You are saving 1 rupee 80 paisa you are saving. So that is what is the advantage. Now, how exactly is it an advantage? So after 91 days, when I go back to the person who's given me the treasury bill, I can give them this treasury bill, and how much will I get? Will I get 98 rupees or will I get 100 rupees? I will get 100 rupees. I will not get 98 rupees. That means what? A treasury bill is a short-term debt which is sold at a discount, but after the maturity period of 91 days or 182 days or 364 days, you can get the face value, that is 100 rupees you can get on your treasury bill. So does it answer the question? So what's the meaning of treasury bill? You know. What is the maturity period of the treasury bill? You know. And third thing is, who is issuing the treasury bill? Also you know. Now, this is the first money market instrument. Let me write it here. This is the first money market instrument, and this is a picture of the Treasury Bill which is issued by the government of India. This is how things look like. The amount will be mentioned, then the maturity period will be mentioned. Okay, see, maturity period will be mentioned. Okay, this is the date of maturity, but somewhere here the maturity period, but for how many days and all, will be mentioned. It again depends whether the company or whether the government wants to mention it. There are public sectors also which is owned by the government. It again depends on them whether they want to mention the expiry date of the Treasury Bill. So this is how the Treasury Bill looks like. You can probably Google and see other Treasury bills as well. The next one is commercial paper. This is a second money market instrument. Okay, the first one is a Treasury Bill. The second one is a money market commercial paper. Now, what is the meaning of commercial paper? A commercial paper is, again, it's a short-term unsecured promissory note. Okay, now what's the meaning of unsecured promissory note? Unsecured promissory note means there is a lot of danger for you to buy these particular commercial paper. Okay, why? Because the money what the companies are asking here is not a small amount of money. It is a huge amount of money what you are investing with them. Okay, so that's the reason it says unsecured promissory note. It's still they are willing to pay you, they are promising to pay you, but somewhere there is a fear in terms of the public investing so much of money with the company. It is negotiable and transferable. What's the meaning of negotiable and transferable? That means you can negotiate. If they are telling I'm selling the commercial paper for 200 rupees, you can negotiate with them and tell them, no, I will pay let's say 199, or I'll pay you 180 for the commercial paper. So you can negotiate with them. And it's transferable by endorsement. That means in case you need money, you cannot wait for the maturity period of the commercial paper. What will you do? You can sell it to a third person who can buy the commercial paper from you. There's no need for the company to get to know about it. Example, there is ABC here. A is the company, B is you, and there is C who is your friend. So what are you doing? You are buying the commercial paper from A, which is the company here. You cannot wait for, let's say 8 months or 9 months until the commercial paper matures. So what do? You go ahead and sell it to C, who's your friend. So C will give you, instead of giving you, let's say on maturity period, you're going to get 800 rupees for the commercial paper. But instead of C paying you 800, he will pay you 750. Okay, so what is it? Why? Because the paper is not yet matured. The paper's maturity is only in the 8th month. Okay, but you want the money even before the commercial paper is getting matured. So that is the reason you're selling it to a third party, so that the third party can give you the money. So what is it? It's negotiable, it's transferable, and it can be endorsed. Okay, and it has a fixed maturity period. You cannot change the maturity period of the commercial paper. If the company says that 8 months is the maturity, 15 days is the maturity, you have to wait. If you cannot wait, you can sell it to a third person. That's the meaning of negotiable and transferable. Now, who is issuing it? Large and credit-worthy companies like Infosys, Wipro, very good companies who have credit-worthy and people can trust them at lower rates of interest. And okay, this is more than enough for you to study. Now, what's the maturity period? Its period is 15 days to 1 year. And the original purpose of commercial paper was to provide short-term funds for seasonal. See, for day-to-day. What's the meaning of working capital needs? If the companies need money for every day, they don't have money to run their business every single day. That's for day-to-day expenses. They can go ahead and raise a commercial paper from the public. With the help of that money, they can run the business. Now, this is how a commercial paper looks like. Okay. So I'm sure you cannot look at the picture really well, but if you cannot really understand, like see how it shows how much is the money value, it shows the amount here, then it shows who's issuing the commercial paper, and it also shows the maturity period somewhere here, but we cannot read through the lines. So what you can do is probably again I would say Google it up and see, so that it's easy for you to understand. Now, the third one is call money market. I told you I couldn't include a pic for you because this is done by bank to bank. Again, I will tell you, this is done from bank to bank. Here, public interference is nowhere there. Okay, what is happening in this call money market? Okay, so the first thing is, it is an interbank transaction. What's the meaning of interbank transaction? Now, let's say a bank. We will take example as HDFC. Okay, here I will try to write HDFC. Okay, and the second bank we will take example is Axis Bank. Okay, every bank has to maintain a particular amount of every day they have to maintain a amount. Let's say cash reserve ratio they have to maintain. Okay, now HDFC is not having let's say Monday it's not having so much money. Let's say 2 lakhs of money is what the RBI has stored. Now this is how it works. Okay, RBI will every day tell the bank you all have to maintain a cash reserve ratio of, let's say, 2000 rupees. Now HDFC cannot maintain 2000 rupees that particular day. So what will HDFC do? HDFC will borrow money from Axis Bank. Okay, so this borrowing of money from one bank to another bank is called as call money. So what is it? It is a short-term finance, okay, which is repayable on demand. You have to repay it compulsory. Now it is done from one bank to another. That means HDFC Bank is borrowing money from Axis Bank. So it's an interbank transaction and the maturity period is 1 day to 15 days. Now you may ask me, ma'am, how is it 1 day to how is it 15 days? Now, if in case the HDFC people are coming and depositing money, the bank can immediately repay the money to Axis Bank. Okay, so probably they borrowed the money just for 6 hours to 7 hours. Now, for that 6 hours to 7 hours, should HDFC Bank pay interest? Yes or no? Okay, the answer is yes. HDFC Bank has to pay interest for the amount of money which they have taken just for 7 hours from Axis Bank. Okay, now I'll come to that particular point later. Now commercial banks have to maintain, this is what I was telling you, RBI will every day tell how much the bank should store money or keep money with them. That's what is called as cash reserve ratio. This cash reserve ratio is set by the RBI and they have to tell the banks how much cash reserve ratio they have to maintain from time to time. So what is happening? If the bank wants to give loan to someone, this and all is affecting banks. Why? Because they have to keep some amount of money called as cash reserve ratio, which has been told by RBI from time to time. What is happening? They cannot give money, or if they have shortage of money, they end up borrowing it from one bank to the other bank, which is called as cash reserve ratio. Now what is happening? HDFC Bank is returning the money to let's say Axis Bank. So when they are returning the money, they have to pay something called as interest. Okay, why? Because they're taking a loan just for 7 hours or just for 10 hours or just for 1 day or 2 days. So what is that rate called as? That's called as call rate. What is the meaning of call rate? The interest rate paid on call money loan is called as call rate. So for 7 hours, HDFC is paying, let's say, 3.54% every day. Okay, every day this rate of interest will keep varying. Like examples here, I've told you in Jan the percentage of interest is 3.54%. Look at the chart here. So what am I trying to tell you? Every minute or every day, every hour, the interest rate of these banks keep increasing, keeps fluctuating. It is unpredictable. So if you have told that I will pay as per your interest rate, I'll pay 3.5%. I will return the money to you tomorrow. Tomorrow the rate of interest will be 4% or 10%. So every day, every hour, the interest rates will keep changing. So what is happening? They have to pay the money which they are forced to be taken. Understood? So what is the meaning of call money? Or what is the meaning of, what's the meaning of call money? Where one bank is borrowing money from the other bank so that they can maintain the cash reserve ratio which RBI has asked them to maintain. So later when they have to return it, they have to pay an interest rate which is called as the call rate. And this call rate is highly volatile. Highly volatile means it's unpredictable because it keeps changing from day to day and every hour to hour the rate of interest keeps changing. Now the fourth one is certificate of deposit. Now what is this certificate of deposit? It is just like if you have money, you go and deposit the money into the bank, right? So first question, who is issuing the certificate of deposit? Certificate of deposit is it's issued to individuals by companies or corporations, okay? And so the three questions which you are asking yourself, who is issuing your certificate of deposit? Companies or corporations, okay? The second thing is, what is the meaning of certificate of deposit? It is again unsecured. That means it's a big risk. Whenever the company is issuing, it's a risk because you don't know when the company is undergo a loss. And it's a short-term instrument. Okay, it's issued by commercial banks also, and it is issued by financial institutions also. But mainly who is issuing it? Corporations and companies. That is what you need to understand. Now what is happening? For what are they asking you this particular money? When the deposits growth of the bank is slow, that means when the banks are slowly moving, they are not able to get a lot of loans, like because of the COVID scenario, the organizations are not able to grow, plus the banks are not able to grow. So what are they saying? This is the right time for you to take loan from the bank and buy a house or buy a property. So what is it? When the deposits in the banks are going very slow, still the banks want to give money, or the banks is in need of money. So that is why they advertise telling that the rate of interest has fallen, come buy a property. Why? Because the banks are also in need of money. And again, the certificate of deposit is again for less than a year. Please remember, all your money market instruments are less than a year, not more than a year. So whatever certificate of deposit, whatever the bank needs money also, they should ensure that repay back your money within a year. And these also, so what is it helping? How is it helping? It helps to mobilize their short-term it's helping to mobilize them, or helping to help them in their working capital for a short period of time. So three questions it's answered. Who is issuing it? What is the meaning of certificate of deposit? You already know the maturity period is less than a year. So even if it's not mentioned, you already know it. So what is the advantage of it? The advantage of it is, so that when the banks are moving very slow, that means when they do not have money, they are still in need of money from the public. So by taking money like this, by issuing certificate of deposits, the banks can grow and ensure that their working capital is managed. They can use that money somewhere else for them, and after a year they can repay it back to the last one is a commercial bill. Now what is the meaning of a commercial bill? I will tell it to you here. I'll write it down. It's between one trader and another trader. I've explained this previously to you already. I hope you have, when I go through it, I hope you can understand what I'm saying. That means what? The purchase, whatever is done here between one trader. Example, this first trader is selling wood. The second trader, let's say, let's say the first trader is manufacturing the blades of the fan. Okay, the second trader is selling fans. Okay, so the first trader is the one who's selling the raw materials to make fan. Okay, ceiling fan or table fan or whatever fan it is. The second trader is the one who's selling the finished output. So he's buying the raw materials from the first trader, converting it into a complete finished output, and he's selling it to the seller. So now what is a commercial bill? When the second trader is buying the raw materials from the first trader, is he buying it in cash or is he buying it in credit? The answer is always, when they are doing business, they always do it on credit basis. Purchase always takes place on credit basis and not cash basis. Why? Because it's business to business. When it's business to business, even if they have money, they will ensure that they will keep some money ready for them. That's for their working capital, day-to-day expenses. They will not spend their money even if they have money. So what happens? Let's say this particular trader has bought raw materials worth of 1 lakh. Let's say today. Okay, he has bought goods worth for 1 lakh from the first trader. So what will he tell? He will tell, let me convert these goods into finished product. Let me sell the fans. Once I make money, give me a net period of net 30 days. Within 30 days, I will repay back your money. So the interest calculation, nothing is happening here. So the first trader will also be very happy to sell things to this particular person. Why? Because he is buying in bulk. He is buying the raw materials in bulk. So the second trader is very happy to buy the raw materials from this particular trader. Why? Because first thing he is giving it on credit. He has 30 days for him to go ahead and pay the particular person. So that is what is called a commercial bill. This is how, it's nothing but it's a bill, but this bill is telling that I will promise to pay so and so amount within so and so date. Like see example, this net terms for this commercial bill is net 90. It's usually net 30, net 60 or net 90, or it can go to net 180 also, or net 120 also. That means net payment terms. Within so many days you are promising to pay the money. Okay, so what is a commercial bill? It is used to finance the working capital requirements of the business. That means even if both the traders have money, okay, they will keep the money for the day-to-day expenses. So when they buy goods from another trader, or when they are buying things from other traders, they will always buy on credit basis. They will not buy on cash. Why? Because they need to keep the money for day-to-day expenses. Now this bill is highly negotiable. That means anytime you want money. Like example, anytime this trader who's selling raw materials want money, what he can do? He can take this bill. He can go to the bank, and what he can do? He can discount it with the bank. Now what is the proof between this trader and this trader? This trader will tell, I have sold goods to you worth of 2 lakhs. I am drawing a bill. This bill will be a proof telling that in the future on so and so date, you will have to repay me back the amount. The second trader is accepting it. The first trader is also accepting it. Now all of a sudden, this trader who sold the raw materials is in very bad need of money. He cannot go back to this person and ask for money. Directly, he knows that the amount will be credited into his bank account. So what he will do, he will directly go to his bank. Let's say he has HDFC Bank. He goes to his HDFC Bank. He tells the bank, I'm in a very bad need of money. Can you please discount this particular commercial bill? Okay, or this particular bill, invoice copy. So what will the bank do? The bank will go through the commercial bill, and they will ensure that instead of paying this particular trader 2 lakhs, they will pay him 1,90,000. Okay, so 10,000 will be a discounted price, and the trader will get back his money of 1,90,000. Okay, now all this information will not be mentioned to the person who's making the final output or the fan. Directly when the due date comes, he will go ahead and he will deposit the money into his account, the bank account of the raw material trader. So what is happening? The bank will get back the entire 2 lakhs and extra 10,000 also from this particular trader. So what is it? It's a negotiable self-liquidating instrument. Okay, and here goods are sold on credit. Okay, and the bill can be discounted with the bank. Hope you understood whatever I'm teaching you. Please listen to it again and again, because it's very easy. It is not very complicated. If it's complicated, please get back to me. I will be happy to help you and teach you over again. Now, what is this trade bill? When both the traders accept, okay, that yes, I have to pay you this money on so and so date, and the other traders say, yes, I promise to pay you within 100 days or within 90 days, that time it becomes a trade bill. It's okay. So when a trade bill is accepted by a commercial bank, it is known as a commercial bill. So example, this particular trader wants to go and discount the bill into his bank. When the bank accepts this document, that time it becomes a commercial bill. Again, I'll repeat, when the trader, he urgently needs money, he goes to the bank and he discounts the bill. He tells the bank, instead of you paying me 2 lakh, you please pay me 1,90,000. So when the bank agrees to pay 1,90,000, that time this document becomes a commercial bill. So until then it's called as a trade bill. Okay, so when the bank agrees to pay, that time it becomes a commercial bill. Now we close the topic called money market instruments. Okay. Now we move on. I'm just giving you an introduction and we will just see the comparison between capital market and money market so that it's a connectivity and it will stay in your mind. Okay. Now what is this capital market? Already told you capital market is divided into two: primary market and secondary market. Primary market means what? It means the shares or the debentures are sold by the company or by the government. Fresh, new, for the first time they are selling these shares or the debentures. But secondary market is not that. Secondary market means the shares are over and over traded or sold in the stock market or in stock exchanges. Okay, so capital market is basically long-term securities. What is money market? Short-term securities, less than a year. But capital market is long-term securities greater than 1 year. Now, who are the people who are investing their money? The companies and governments are the ones who are asking the public to invest their money into buying these particular securities, and the amount you will be investing can be any denominations of thousands, lakhs or crores, but it will be greater than 1 year so that you can actually get the fruit out of what you are investing. Now, basic difference. Now, why you may actually think, why am I doing this topic now? The main reason is because you learned what is the meaning of money market in this particular session. So if you know what's the meaning of money market, for you to learn this particular difference is easy. So that is the main reason I'm doing this topic with you. So let me start with this. What is the meaning of money market? It is a short-term fund, okay, where the maturity period is less than 1 year. Okay. Now, what is a capital market? It is a long-term market where the maturity period is greater than 1 year. Simple. Now, who are the participants? Participants means who are the people who are selling money market instruments. I told you RBI and banks, financial institutions, companies are the ones who are selling these money market instruments. Basically, it's RBI and it is banks because you have call money market. Then you have financial institutions like organizations who are selling instruments of money market. Now, who are the people who sell all these shares and debentures in the capital market? The people are again institutions, banks, corporate entities, MNC companies, then foreign investors. Who are foreign investors? It's nothing but foreign organizations, okay, who ask the public to invest the money into these particular shares or debentures. Now, what are the instruments? Instruments means what are the money market instruments? You have 5. You have Treasury Bill, you have Commercial Bill, Certificate of Deposit, then you have Trade Bill, okay, then you have what else? Call money, okay. So now what are the instruments here? So this you already know. Now, what are the instruments here? Shares are sold, debentures are sold, bonds are sold. Basically, shares and debentures is what you need to understand in capital market, because shares and debentures, whenever you invest your money into shares and debentures, you will always gain profit if the maturity period is more than a year. If it's less than a year, you cannot gain a lot of profit. Why? Because even if you are investing 10 rupees to buying one share, that 10 rupees buying one share, you will only get advantage, or you will get 15 rupees after 1 year or after 2 years. Immediately you cannot make easy money in this capital market. But when it comes to money market, you can make easy amount of money. Why? Because the maturity period is less and the amount what you're investing is very much, probably 5 lakhs, 10 lakhs, 1 crore. Okay, so the next point is investment outlay. Now, how much are you investing? I just said you are investing huge sum of money. Why? Because these bonds and documents are quite expensive. But when it comes to the capital market, for you to buy the shares, you can buy the shares at any price, 100, 10 rupees, 500 rupees. Again, it depends which company shares are you buying, because there are thousands of companies who are going ahead and selling their shares and debentures, and whatever profit you're making is going to be greater than 1 year. Probably it's 3 years, probably 5 to 10 years. That's when you make proper amount of profits. What is the maturity period? Maturity period is less than a year. Here, maturity period keeps ranging, either it's day to day or whether it can be greater than year. Basically, it's more than a year. Sorry, I'm doing it opposite. So the maturity period, see the capital heading here, it says capital market, here it says money market. So capital market maturity period is more than a year. In money market, it is less than a year. That ranges from 15 days to 10 days to 1 day, like call rate, okay, from bank to bank. Now, liquidity. What's the meaning of liquidity? Can you easily sell your shares? Can you easily sell your money market instruments? Okay. So first we will do money market instrument. There is formal arrangement of creating liquidity. What is this arrangement of creating liquidity? That means even if you want to sell your particular money market instruments, you need to do it in a very formal way of first informing the company or informing the government. You cannot just sell it to whoever you want. But here what is happening, you can log on to the stock market website. You can enjoy by selling your shares and debentures anytime to anyone. The company doesn't even have to know about it. But when it comes to money market instruments, it's done formally. Why? Because the company will put its head into it, because you're directly selling it to the company here. But when it comes to capital market, it doesn't mean that you're directly selling the shares to the company. You can sell it even to a third party person. That's another friend of ours or a public. Now, safety element, which is more safe. The transactions are made in instruments issued by financial institutions, okay, and financially strong companies. Why it's strong companies? Because you are investing a huge sum of money for a lesser maturity period. But when it comes to your capital market, you yourself have to do a thorough study of which organization shares, debentures you want to buy. So there is a broker in between who can help you to buy the shares. But again, if you make the wrong choice to buy the shares, wrong company shares you buy, your entire money will undergo a loss. So safety wise, your capital market is not very safe, but your money market is very safe. Now, expected returns, which gives you more returns? Capital market gives you more returns, money market gives you high returns. You may ask me why. The main reason is the maturity period is greater than 1 year. So even if you're investing 100 rupees and you're investing it, let's say, into one very good organization, what is happening? After a year or 2 years, 3 years, the company is earning profit. So your 100 rupees shares will become 500 rupees. But here what is happening? The money market instrument, they are telling you that the promised rate of return, you are saying 10%. So you only get that 10%, which is because the maturity period is less. Yes, so I'm sure this topic is easy for you. It may be too much, but I'm telling you, please understand again. This is an 8 marker. This is a sure 8 marker, and please go through the topic. It's not very complicated. If you know the meaning of money market and its instruments, you know the meaning of capital market, it's very easy for you to do the differences yourself. And once again, the underlying terminologies are something which you can learn. Write it down, only the underlying terminologies, and only study that. That's more than enough. And this again is a marker. Okay, so in your next class, this is what we are going to be learning. That is primary market and your secondary market. That means your capital market, okay, your capital market is divided into, okay, your capital market is divided into primary market and your secondary market. So next class or next session, we will be studying what is this primary market, what is the secondary market. Today we completed what is money market and what is the meaning of capital market, the difference we finished. So next session, I will be teaching you what is primary market, what is secondary market. Both this comes under the heading called capital market. I hope today's session was really good for you, fruitful for you, because today we learned 16 marks or 20 marks of what answers. So please ensure to listen to the video again and again. Anywhere you get stuck with any doubts or any questions you have, you can feel free to message me, text me, put in a comment so that it can help you. I would be really glad or happy to assist you. Please start studying, and please like and please subscribe so that you will know that this particular topic is important when it comes to learning. Thank you so much.